And guess what, y'all? We're live.
Hey now.
Although I need to fix my lighting.
Oh my gosh, it like just it was all out. Like the totally was not there.
Well, it's not even a Tuesday or Thursday, so it's all good.
Oh, all right, let's go.
So she just don't discount everything?
No discounts here. None of that. Guess who's the first person today?
Is it someone regular?
Yeah.
Reggie.
Yes.
Hey, Reggie.
Yes, Reggie, you are continuously on it. I don't know, like, yo.
I don't even know how he does that.
Straight up notification. Like, as soon as that notification hits, boom, I'm there. So shout outs to you, Reggie. We love you, cousin, and keep doing your thing. Keep shining bright. And to all of you, keep shining bright. So what's up, everybody? I'm Mark Monroe, accompanied by some pretty phenomenal people. I'm accompanied by, of course, my wonderful co-host and co-producer of the Come Up series, the wonderful
Jolene GC in the place to be. What's up, y'all?
And we also have two awesome, phenomenal cousins. We got our big cousin all the way over there in New York.
You know it, man. You know the vibes, bro. You already know.
And then coming all the way down from the West Coast side, all the way down there in Cali, Los Angeles. Shout outs to our other cousin.
We're here.
Christopher Bush. All right, y'all. So today it's going to be a little bit different because of the fact is we've been getting a lot of accumulated questions from each and every single one of you. And we kind of felt like we would be remiss if we couldn't, just spend some time, take a day to just answer some of the questions that you all have. So if you can, share the video if you like, because I know that this is outside of the Come Up series schedule, but we're doing it for each and every single one of you. So salutes to each and every single one of you cousins. So today it's all about finance. So you'll hear questions about walkaway. You may even hear some questions about just general finance. And then on top of that, you may even hear some questions about credit cards and credit. So we got the whole kit and caboodle for you. So this is one of those episodes where honestly, I'm on my moderator type vibe. So I'm going to be sure to, make sure that I reset the room. And first say, if you haven't subscribed yet, go ahead and hit the subscribe button. And if you like what we do, go ahead and hit the like button. But if you think that there's room for improvement, it's okay to give us a dislike. We can just always get better and just make sure you tell us why. And then on top of that, if you want to be in the know and be like cousin Reggie, whenever we drop a video or whenever we go live, he's the first one there. You can be there too. So go ahead and hit that bell so that way you're part of the squad, AKA the Cool Kids Club. So, Jolene, there's a lot to discuss here. There's been a lot of questions, but first off, how are you two doing? Like Chris, how are you? Q, how are y'all doing?
Welcome back.
You guys are going to be taking a run-in of a lot of these questions today, and I'm probably sure we may even sneak one in there for Jolene. But
I'm excited, man. I'm just ready to get it going, answer some questions. Just make it a great show.
All right. And Q, how are you doing over there, brother?
I mean, I can't complain. Anytime you got Chris Bush in the building, it's a celebration. My man's always coming through, so I'm just happy to be here.
All right. So let the gems begin. So do we want to like open up the room for any opening remarks here, or are we just trying to go 100% for it? Are we going for the gusto, or?
I mean, we could set the tone. We could do a little tone setting. What's up, y'all? Shalyn
That's how you know it's gonna be dope.
And you know what? I just want to say that we had so many questions about this walkaway. Like we've been collecting all these questions, and part of the questions, I was like, okay, some of these are totally wealth rituals vibes, so I'm gonna address it there. Some of the questions were like, oh, these are definitely for Chris. Some of the questions are, these are definitely for Q. So it was just one of those things where, Chris was in town, and Q was just with us yesterday, so he was just like, okay, bet I'm here, it ain't nothing. So it's awesome to be here, on a Wednesday. And I just want to say that this is about our collective walkaway. So these are the type of questions that are about like that wealth, and how you manage it, how you navigate through it, like we talk about how you get there on the Tuesday and the Thursday, but this is more so about like what many of you have to look forward to. Because let me say, like, as someone who does not work a 9 to 5, like I live off of my investments. I take out, and Chris will talk more about this, but I'm able to just take out my beginning of the year amount, like I know what my expenses are, and I just take that out, and nothing that I have now what came out of my pocket. It all came out the market. Just whoop, all that came out the market. And being able to be in that position, I do not take that lightly. I do not take it for granted either. And that's how I'm personally able to hold the space for each of you to have your walk away, because I'm there. So I know what it looks like. I know what it feels like. I know what this air smells like. And I cannot wait for each and every one of you to get there. And in order to get there and to stay there, there are some things besides just the rolling fours and the roaring 20s method and all those different things, the 70-30. There are things that you need to set up, like your accounts, and you have your teams. Like, just like the Come Up series is a team, when it comes to building wealth, it is a team effort. You need your squad. And I'm not talking about your homies. I'm talking about these experts, like people like Christopher W. Bush, where he can help you set these things up. So this, for many of us, like if you did not grow up with money, all of this is new. This is all new to me. And I'm so thankful to have a team help me navigate through it, just like we're a team that's going to help you navigate to it. And so what's really, really dope about tonight is that each and every one of us are holding the space for your walkaway. We are holding the space. Like, we know that you're going to be there and we can't wait. So just imagine what it's going to feel like. That Come Up Cousins cookout is going to hit different when a good portion of y'all have walked away. I'm just saying, like, you walk a little different. There's a little pep in your step or whatever. And so I'm here for it, and I cannot wait to get into it.
All right.
Good.
Okay. First on the docket. So I'm just kidding. All right, question number one. And so these questions are going to be pretty much open for the room. So feel free. Should walkaway money be invested in Roth or brokerage?
Good question. I guess I can start with there. So Roth or brokerage? I think it's going to need to be brokerage.
Okay.
Right. Brokerage for one. Because you got to think about this, guys. I'm really big on, if we're going to use an account, right? Let's say we're happening to a Roth IRA, traditional IRA. We want to be able to use those accounts in the way that it's actually structured, right? In a Roth IRA, we know this. If you're under 50 years old, you only can do $6,000 a year. But if we're trying to withdraw before 59 and a half, technically we can withdraw from a Roth anytime, but we only can withdraw the contributions. Mm-hmm. So if we're doing the strategies that we talk about, if we're getting a huge rate of return, well, our contributions may be 6,000, but our profits, if you look at the Come Up account, right, it may be over 100, 200,000, $1 million by the end of the year or something, right? 2 million by the next 18 months, right? So we're going to have a small amount that we contributed, but a ton of gains. So see, what's going to happen if you start to pull those gains, you're going to be taxed as ordinary income, right? On the money that you pull out. So that's what I'm saying. Don't just always depend on that Roth for walk away. You're going to have to need a brokerage account, right? Make sure we hold those positions for a year and a day so we can be on a long-term capital gains tax rate instead of a short-term.
Okay. Now, is it okay if they have both of those?
They need both.
Okay.
You got to have both.
All right.
Because in some cases, you will be utilizing that Roth. So it's not an either or, it's really an and situation, to where you should have a Roth IRA. If you're to make too much money, you should have a traditional going to a back door, and then also having that brokerage account to where you're able to scale that, right? And then you should be pulling off that quarterly, that yearly income from that brokerage first, right? And then maybe that Roth.
Okay. All right. So what would you say is the best way to set up an emergency fund? So like, well, let's make it two-part. Okay. So what's the best way to set up an emergency fund? And then how much to have aside before investing?
This question always gets me, right? Because I think it's really going to be based upon a couple things. Number one, your own financial knowledge, right? I think somebody like, Mark per se, he may not say, hey, Chris, I need this huge emergency fund of cash because he knows how to trade, right? He knows how to make money. He knows what his portfolio is going to do. He's not going to be upset if the portfolio drops 30% like it's done in his last couple of weeks because he's understanding the process. So I think it grows. In the beginning, if you have a job and you know that your job isn't consistent, they can fire you any day. Your income may be fluctuating. For that person, they may need more of an emergency fund. Okay. Right. However, as your income grows, as your investments grow, I would say, look, maybe have 10 grand, 20 grand, right? Not just for emergencies, but also for other opportunities. See, I hold an emergency fund account for two reasons. Not because I'm looking for that emergency in my life, but maybe it's another downturn like we have in March to where, okay, well, I have excess cash sitting on the side that I can deploy and average down and get better deals like we're seeing right now. Right. So that's how I see an emergency fund. And then since you have an emergency fund before investing, no, you should do that at the same time. Okay. Right. You should not wait. Oh, I'm going to build this emergency fund for these next 2 years while I, and then start investing. No, that means you just would have missed out on 2 years of growth. Yeah. Right. So it's not a either or, it's an and situation when it comes to having an emergency fund, investing money at the same time, but it needs to fit your entire plan.
Well, Chris, I have a quick follow-up question on that. My follow-up question is, we kind of look at ourselves as our own CEOs or CEOs of our lives. Would you say then the people, they should have like cash as a position on their balance sheet, right? On their, we look across what you have. Like we look across your credit, your asset, the accounts you have, would cash be a position on your balance sheet as a CEO of like your life or your financial portfolio?
Absolutely has to. We can't hear you, Q.
You can't hear me?
I can hear you.
Yeah, he was good. I just had it down on my side. Go ahead, Q.
Oh, my bad. No, I just wanted to ask him that because I think that's an important thing to note, that a lot of times people don't like to hold cash. And though you want to have it in the market and you want to make sure you're getting the most in your returns, I think when you start to look at life as you're the CEO of U Corp, that your positions across the board, right? So you look at credit, it kind of like your bond portfolio, your preferreds to a certain extent, and then you look at your cash as an opportunity fund, right? Advantage of downturns in the market, or if there is an emergency, right? So kind of going back to what Mark and Jolene really teach as far as you being the CEO of your life and you being able to have that balance sheet, and those quarterly check-ins are so important. To make sure that you are growing your cash balance sheet, right? That is something that you're growing over a period of time. That way you can take advantages and being patient and striking at the right moment.
I mean, that's a huge point too, Q, because, and I think there's also like different types in emergency funds. Because like if we evaluate a company, we want to see a company that has cash on the balance sheets, right? If the company didn't have cash, how will we really invest with that company? Right? We love Apple because they have so many billions of dollars in cash. Mm-hmm. Right. So when like you said, if we're managing our money like a CEO, we should also have that too. But then also in personal finance, there's different forms of emergency funds or cash. Number one, you can have it into a tax-free account, right? You can use maybe municipal bonds, right? Municipal bonds are federally income tax exempt, right? So if you live in a state that bond is issued, now becomes state income tax exempt. So now it's first state and federal don't have to pay any taxes. Right. So that money will typically grow between the 2 to 4%, right? More than you would at a bank, but still safe and secure. However, going back to what Q said is I want to look at somebody's full financial plan, because for me, if somebody has their own, actually did this with a client, if you have their own home right now, your home has like $300,000 of equity. Well, my thing is that's also another form of cash and credit. Yep. Because now if I take out a HELOC on that home, right, I get access to my credit. Right, I'm gonna get access to my equity. If something happens in the market, if something happens in my life, yes, I may have a true emergency fund, but also I may have access to a HELOC to where my interest rate may be a 1 to a 2%. So if I need the money, I can pull from the HELOC, not mess up my credit, not do anything else, and pay it back over time. Yep. So, right, there's so many different ways that you can access cash. So that's where it's not really a one-trick pony. When you look at a full financial plan, we got to look at everything that we have access to as an asset and also an opportunity for the next step.
Now, Chris, I definitely want to get back to that, but a question just popped up. as I was just thinking about.
That's so funny. Everybody say I'm always shouting. This, if y'all don't know me,
that was me. That was my fault. I had the volume.
No. So if y'all know me, I'm always passionate. I'm gonna talk loud, talk fast. I'm excited.
I like it.
Always on point. So we're gonna make it happen.
I like it. Now, I do have a question that just popped up, and this question is for Q. So Q, you know, in my daily leisure life, I hardly ever use cash. It's either my Apple Card for convenience, you know, with the little tap, you know, fintech all day. I know you like fintech. Or I'm using my American Express, and because of the different rewards that it has. So my question to you is, like, in this, as we're like thinking about, you know, what you said about being the CEO of our lives, you know, of You Inc. What are the strategic ways and responsible ways that we can use credit to our advantage and like as a leverage for our walkaway life?
That is a good question. So I think when you look at credit, a lot of times we kind of view it as something that is like, we're going to buy something that we can't afford and then we'll pay it off, right? That's what most people would do. Most people say, hey, I have this credit card. I'm going to buy this MacBook and I'll make $100 payments for 12 months and pay it off, right? I think when you look at credit, you have to look at it as leverage, right? So I look at it as leverage. I'm leveraging what I normally buy. What do you buy? Every year you have a spend. I look at my spend. I go, okay, I know I got to pay rent. I got to pay for groceries. I have to pay for my car. I got to pay utility bills, right? When you know your spend, you can leverage that into your credit cards and say, okay, I'm going to look for cards that leverage my spend and give me points and or rewards for spending money that I was already going to spend. So for the most part, I never use my debit card, never use cash, because when I swipe my credit card, I get paid for doing something I was supposed to do. The equivalent is if I gave you $1 for every time you brush your teeth in the morning, you're just doing what you're supposed to do in a responsible way. So I view my credit card portfolio the same way as my investment portfolio. I have an investment in credit cards in which it allows me to either make extra money or extra reward points that take some of the pressure off of my everyday life. So at the end of the year or at the middle of the year, if I want to go on vacation, I can use those points for a hotel. So as opposed to spending maybe $1,000 on a hotel, that's free. That's the extra $1,000 that goes into the market. At the end of the year, if I want to wait for Christmas shopping, now, as opposed to me having to spend $1,500, $2,000, I can use my points. I can use the money I have towards Christmas shopping. That's $2,000 in the market. When you track your spend, it's the same thing as how companies track what comes out and what goes in, right? They leverage credit. When a company wants to maybe purchase another company, what do? They raise capital. And so I view a credit card as me raising capital for myself over the course of the year. So that way I can leverage that capital to make a purchase, maybe something I want for myself. We're all human. But at the end of the day, I'm leveraging somebody else's money because they're going to pay me to do something that I was already going to do. So if you can responsibly use your credit, right, and not buy things that you're not meant to buy, you can really add anywhere probably from $1,000 to $3,000 a year of value that can go into the market. And we all know one contract at a 10X can change a lot for a lot of people. So when you think about the power of that contract, that's really where, you really want to hone in. And then you start getting strategic with your spend, right? Case in point, I have a credit card that allows me to get 5 times back points on going out to eat, right? We go out to a big dinner, 10 people. Hey, I'm going to swipe my card. I'm going to get free points and free money for doing something that I was already going to do. Everybody else just hit me with the bread on Venmo, Square, or whatever. So I think being strategic, leveraging, and then looking at credit as the same way you look at your portfolio on an everyday basis is a real game changer to the everyday retail investor that's not really spoken about.
Yeah, I like that. I like that perspective of looking at your credit as not only just leverage, but also like an additional type of portfolio.
Now we're about to be seeing everybody who goes out for large dinners. Everybody's going to be.
Don't worry about it. I got the business.
Everybody's going to be playing rock, paper, scissors.
So this is what we do, right? So for my friends that are really enlightened like I am, we play credit card roulette. And we put the credit card on the table and we allow the waiter or waitress to select the credit card. Because people have caught on to my tricks So I can no longer abuse that as much as I normally could because my friends around me have picked up on what I'm doing.
Well, that was Q in the room, was he? Mm-mm. We were, it was kind of crazy, Q. We were just yesterday, we were just talking about, we were ordering food. I was like, look, let's just play credit card roulette real quick. They weren't ready. They weren't ready.
Well, wait, time out. I was ready.
Okay, Mark was ready. He wasn't hungry. That's what it is.
I know that the other day I went to lunch with a friend, and you know, I'm used to paying. I just don't even think about it. I'm like, oh, you know, I got it or whatever. Like if I'm out, because I know that I like to order, you know what I mean? So let me get this appetizer, let me get this, let me get that. So if I'm with someone, you know, whatever they got doesn't even compare to what I got usually. And I was out to lunch the other day, and it was a beautiful day in Seattle. This was yesterday, actually. It was beautiful, or no, not yesterday, Monday. And the sun was out. And you know what? My friend like paid, and let me just tell you, I really do appreciate it. Like it was just the thought that counts. And so like I get that Russian roulette, or what do you call it? Credit card roulette? Credit card roulette. I think that's dope. And also it feels great to be treated.
All right. So speaking of which, I know it's the biggest thing in the room. It's now starting to happen, and you're starting to hear about a lot of folks that are going to start receiving it. And I think it's going to be like the word of 2021.
Come on.
The stimmy.
It is.
The stimmy.
The stimmy is the word of the year. And so when we talk about stimulus money, right? Should it be stimulus money to debt or stimulus money to investing?
Mm.
And Q, I'd love to hear you chime in on this one too. And Jolene, feel free if you want to hit this too.
Oh, you already know the answer.
I'll come after Q. How about that?
So is it for what's the stimulus money for? To
it's
invest?
Either stimulus money for debt or stimulus money for investing. Because we've been hearing a bunch of it, like different, like, competing, like, you have your Ramseys of the group, and then you have your Ormans of the group, and then, everybody else in between.
All right. So I'm a big proponent of you can't have a nice lawn in a dirty house. And so I think that when you look at debt, it's something that has to come off the books because it allows you to wield a bigger sword or a sharper sword. We often, again, going back to being the CEO of our lives, we often judge companies. Why? They have a lot of debt. Case in point, AT&T, when they bought DirecTV, what killed their stock was they had $234 billion worth of debt, right? Which would make them the 33rd largest country in the world as far as debt. They have more debt than like Singapore. And we judge them on that, right? And so in our everyday lives, I want to get rid of debt because if I can invest without debt, that means my capital is free. And a lot of times, if you have debt, let's say, for example, credit card debt, then you're going to have to outpace your rate. And if your rate's 25%, 30%, 29%, then you're going to have to outpace it. And essentially, you're paying a fee, right? Because you're not paying the card off. You're paying that fee every month. So the money that you're making in the market is actually deteriorating to a certain extent, depending on how much debt you have. So I'm a really huge proponent of clearing my debt because the market is cyclical. It's not going anywhere. It's not going out of business, right? But I need to make sure that my house is clean. I can't have a nice front yard and then have roaches in my house. It doesn't look good, right? As far as when somebody actually walks in. So I look at it from that standpoint. And I think it's really important to address your balance sheet first and make sure that your balance sheet is clean and then investing in yourself moving forward.
Bro, that's perfect, right? So I'll add one thing to it. So I think when we're looking at not just our stimmy check, but everything else. So if we're looking at debt, one of the first things that I want to do is number one, how can I renegotiate our debt? How can I refinance my debt? Right? Because a lot of times, right, if you have over a 680 to a 700 credit score, a lot of times we can do what Q says. He's a credit card guy, right? We can probably move some of those balances to a 0% card, right? But again, you need to have a great credit score for that. So to really look at your overall plan and say, hey, look, what do I need to do with my credit right now in order for me to get to a 680 to a 700 plus credit score? Right now, I can move things to 0%. Once things are on 0%, now more than likely my minimum payment is going to drop. right? I'll have extra money or free cash in my pocket that I maybe can go invest a little bit, but also I can make sure that I'm paying off debt. But see, every single month, now those payments are going all towards principal, not towards interest. So see, I think that's where we're looking at, should I pay off debt? Should I invest? Again, we can do both sometimes, but now we got to really focus on paying off the debt. But let's get that debt down to 0% interest. Yep. I don't want anything accumulating interest. That's not working for me. And the good thing is, if our credit cards are getting a 20% interest, but if we pay it off, we just got a 20% rate of return immediately, right? You immediately got that 20% rate of return on multiple cards. That's instant money. Yep. So.
And to touch on that, Chris, I think that's really a dope idea, right? When you think about 0% interest cards, again, goes back to what kind of card fits your lifestyle. And there are cards out there when you do your homework to say, okay, not only am I getting 0% interest, say for 15 months, which gives me a runway to pay that debt off without having to pay interest, but sometimes they'll give you, $300, $500 for spending X amount of dollars in so many months, right? So not only are you clearing that way, but you're also adding to that, right? So that $500 can actually go to paying off the debt faster if you find the right card, right? So some of that stuff, again, is intrinsic and how you use it, but you have to be patient with it. Credit's the one thing that is not an overnight remedy. It's something that you have to work your plan, and it takes a little while to see the fruits of your labor. But I think that it is something that adds leverage and is so important, and we don't talk about it enough. It's something that we're maybe scared of, or maybe older generations have told you, hey, don't do that, or like I said, bad habits. But what it does is it allows you to leverage what you're already doing. And as you're getting more money, right, you're making money in the market, you're leveraging yourself, you're creating a bank basically for yourself. And so if you think about it from this standpoint, the two most important things I want to emphasize is that your utilization and your payment history, right, that makes up 65% of your score. And so understanding how important that is, because that credit volume, right, for utilization wise, if you have $10,000 of revolving credit and you're using $5,000, well, you're at a 50% utilization rate. That will tank your credit score, right? And now you're sitting there wondering, what's going on? And maybe sometimes you're a big payment away or a couple payments away from actually having a higher credit score because you just need to fix your utilization, right? So really getting under the hood and understanding what you have to do.
So can we break down what is like the credit utilization for folks? Because I feel like that, like sometimes, like, I think a lot of folks understand it, but for those in whom are maybe just getting started and understanding their credit, or also probably trying to understand their credit for the first time and how to utilize it, like, let's break it down for them.
So in essence, your utilization is basically kind of what it says it is, right? So everybody has a roundabout number of credit. So for example, you might have a total of $100,000 in revolving credit across 4 cards. Let's say, keep it simple math. Each card has $25,000 on it, right? And then as a whole, they look and they say, okay, you're using, 10% of your revolving credit. So you have $10,000 in debt that you're holding, right, that you need to pay off or at some point in time. So your utilization would be 10% of that was $10,000. And so when you look at utilization, it's really, really important how that's structured, right? Because it even goes down to the card. So for example, if I have a card and a card has $1,000 balance, I'm using 900. I'm at 90% utilization on that card. So keeping your portfolio of credit cards open is so important because, number one, you're using cards that have purpose, right? If you get gas and groceries, find a gas and grocery card. Don't use a travel card, right, to pay for gas and groceries. You're not getting anything from that. So your utilization is going to be made up of the total amount of credit that you have versus the total amount that you're currently using or that you owe back to the bank.
Now, there are some questions about student loans. How does that fit into this debt conversation?
So are we talking about like student loan debt versus credit card debt? Which one do you pay off first?
I'm not sure. There was just someone that kept saying student loan debt. So whatever comments you have on that.
Man, it's like student loan debt is like a pain. Like I just hate student loan debt, right? I don't even want to even talk about it. But I will say this, number one, if you do have private student loans, the first thing you got to go work on and see if you can refinance it, right? You can easily refinance your private student loans at a better rate than you can federal, because what happens with private, you don't lose any benefit. right? Sometimes if you take a federal loan and refinance it outside the Fed, right, outside Navient or whatever, now you lose that benefit. Oh, well, maybe I can defer it, or I can put into forbearance, those type things. So one thing that I'm big on is that how our student loans are being paid, right? So if you look at your student loan account, there may be some student loans at 8%, I'm sorry, 6%, 6.8% interest, 5.2, 3%. So what I'm gonna do is I'm gonna take the payments off automatic, because now with student loans, especially with Navient, they're gonna dictate when of course it's in forbearance now, right? They're gonna dictate what your minimum payment is. Okay. They're gonna dictate where the money goes to which loan. So what I focus on telling my clients, let's remove the automatic payment. Right now, let's actually put our student loans in a debt elimination plan, or a debt stacking plan, a debt snowball plan, right? Manually.
So what are those? So that way, just in case.
Lord have mercy.
Oh, sorry.
No, you good. So, okay, so I guess there's three different things, right? You can do a debt snowball, right? Which is typically you're going to organize your debts from, I guess, the highest interest rate to lowest interest rate. You're going to pay off the minimum. You're going to pay the minimum payment on everything. Then have a target account. Once that target account is paid off, use that extra money for the next debt. But you're still paying the same amount of money every single month. Let's say it's $1,000. But instead of paying all of your debts, like if you have an extra $500 a month, don't pay $50 extra on each card. Have a one target account. So that full $500 goes to one account. Like, let that get paid off. Roll that money to the next card. Right, that would be a debt snowball. Okay, right. You also can do like a debt snowflake. Have y'all heard of debt snowflake? Y'all heard of it?
I have.
Right. So a debt snowflake would be using like micropayments. So one thing that I do is I'll combine it. I'll use a debt snowball or debt avalanche, right? Or you can do another thing called cash flow index. But use a debt snowball. That's on a little episode, right? So if we use a debt snowball along with a debt snowflake, what does that mean? You can actually, there's an app that I use called SpendDebt, right? So SpendDebt is an app that I use that'll let you attach your debit card or credit card to an account, to where every single time that you swipe a debit or credit card, you can say, hey, look, I want a micro payment, i.e. a snowflake of $1 to go towards paying off my debt. So let's say, for instance, you have a cup of coffee, it's $3, right? When I swipe my credit card or debit card for that $3 cup of coffee, if I have a $1 additional payment, it'll actually ring up as $4. That extra dollar goes towards my debt. So now if I'm swiping my credit card for, like, let's say maybe 100 times a month, right, for any transactions, that means that's an additional $100 that's going towards debt that I didn't even know. So now, while using a debt snowball, using a debt snowflake, you can kind of combine those things and really get out of debt a lot quicker. And that works on car loans, student loans, credit cards, pretty much everything. So that's, SpendDebt.
Okay, so how do we spell that? So that way we can like go ahead and.
Yep, so www.spendebt.com.
EBT.com. There you go, y'all.
I think it's EBT, right? Debt, yeah. That's how you spell debt. DEBT, yeah.
There it is. All right. Is it on me?
Yep.
Okay. All right. So can you still get approved for loans and mortgages with only investment income and no W-2?
Absolutely. So if somebody's retired, right, that's one way that you can do it, right? As long as you have income coming in, you can prove it. You can do like a bank stated loan, or they'll go based on your tax returns. Well, if you're getting income from your investment account, your tax returns are going to show that you earn income throughout that year. They're going to probably ask for 3 months or 2 months of bank statements, and then your assets, right, your balance sheet. So you can absolutely get approved for loans, homes, even while not having a W-2 job. Now, there are some lenders that may want you to have a W-2, so you probably need to work with a broker that can actually broker out your deal to make sure you're getting the best financing, and they have more lenient restrictions as far as loaning and lending.
All right. So how do you know, this is a question that's really popular. How do you know when or how much is a good point to walk away?
Mark?
Mr. Walkaway himself.
When your passive income supersedes your expenses. So essentially when, let's say that you make about $50,000 a year. And then essentially you could probably walk away with about, when you reach, I think 250, then you're free to walk away.
Man, you just make it sound so simple. Just get 250, walk away.
Because I mean, literally, it's like, you know, if your investments ultimately, you know, if you started off with X amount of capital, and then essentially, you know that you make 50,000, you know that you like probably like spend somewhere around $50,000 a year. So if you have a family and that's what you need to spend, then essentially it's like, okay, hey, now to sustain yourself, if you put it into perspective, now you walked away with 250. So then that first 6 months, you probably drop out 25K to cover for that first half of the year. You still have the rest of the capital investing.
225.
So then essentially after that, then that 225 should probably, you know, by the next 6 months, it should appreciate to some number, let's say about maybe 350, 400K. And then you take out the other 25 to ultimately cover, and then boom. So the reason why I say that is because if you, you know, in other cases, you could just take out the full year's worth of salary. There's nothing wrong with that. Now, for me, just as a disclosure, I typically do it on a quarterly basis. You know, that whole thing, that March, June, September, December. Yeah.
That quadwitch. Okay.
I'm on those kind of vibes. So
I see you.
yeah, so essentially what you can do is, and most likely if you've been living that good old 70-30 or, you know, less than that, pretty much you can literally just do that on a every quarterly basis or a semi-annual basis. And essentially from there, you've been able to walk away, but all the while still keep the money growing.
Absolutely. And
So,
oh, go ahead, Julian.
no, I was just gonna say, like, so this is why getting to 70-30 is so powerful, because now not only does it seem like most people, when you think walk away, you know, they think, oh, I need $80 billion to walk away. And it's like, if you get your expenses down reasonably, you can walk away sooner than you would. And the whole point of the walk away is not even just for you, you know, it's for you and generations after you. So if you just keep that 30% expenses like and lower, because it is possible to be even lower than that, you are really positioning yourself to live a life where, you know, you can still have a stunt campaign. Don't get it twisted. You can still stunt, but you do it in a way that will allow your greats to also stunt. That's the real stunt, when it's you and your entire lineage, you know. So also keep that in mind. And then there was something else that came up.
Well,
can I piggyback off that, Joel?
Well, everybody
Yeah.
Like, this is rated E for everyone.
Yeah, I think this is dope, right? So we invest in these companies, right? And again, it goes back to time and everything. We invest in Apple, right? And one of the reasons why we liked Apple so much is because why? They started making their own chip. They brought their expenses down. They widened their margins, right? And it goes back to tie it in of us being our own CEOs. You have to figure out as a CEO of your life how you can bring your expenses down to widen your margins, right? And by doing that and still producing at the same level, they're able to increase their cash flow, right? And so from the same point of a regular person, it's like, okay, if I can bring my expenses down, right, that means that I'm widening my margins, because what I take home gets bigger. And now I have more to play with, whether it's investing, bringing down debt, right? Ultimately speaking, it's increasing my cash levels, right? And what makes Apple so attractive is a company with very little to no debt, with extreme cash levels and great margins. So be the product of what the products you use, right? In the sense, because you use these products and you love these companies for these reasons, you can basically use the same formula for yourself. And get to that same level of cachet, let's say, in your lifestyle, right? Without having to have $1 billion. It's about how efficiently you run your life.
You know what the biggest stunt is, though? Because, you know, I love a good stunt campaign. The biggest stunt is to be able to, one, have everything that you need taken care of, where you're in the position where you can literally have anything you want, whatever experience, whatever item, whatever. But then also to be in the position to bless someone else's life and it not even hurt it. You don't even feel it, but you just have that much where you are like living in the overflow. And so you can give from that overflow. Like, that's the biggest stunt ever. It just hits different. It really does.
And I think just to add to like the walk away type of deal, I think there's different levels of walk away, right? Your walk away looks different as you progress, right? Your walk changes, right? Just like Q talking about CEO of your business. So over time, a company is going to add more products. A great company is going to evolve, right? So initially your walk away, if you're making $50,000 a year, your walk away may be $250,000, right? That's step one. You may be pulling off money quarterly or pulling off money annually. So, but see, as you build your financial plan, right now, your walk away can be a little bit different, meaning that, okay, so if my portfolio is $3 to $5 million, right, that I have in a portfolio, well, I know I can pull off my options, but maybe I want to mitigate taxes. Maybe I want to save money that way. Well, instead of pulling off my individual account, right, my TOD account to live off my money for my walk away money, then if we have a portfolio that may be in dividends. So that way, a dividend income, qualified dividends are taxed less than capital gains. I'm sorry, they have a lower capital gains rate, right? Qualified dividends pay less taxes. So now what we can do is we can have, $1 million in a dividend portfolio, right? 2 million in dividend portfolio that'll kick out $100,000 to $150,000 to $200,000 a year in dividends. So now our money stays invested inside of our investment account. Then our money is also growing because we should be in a great dividend producing companies, right? But also a little bit of growth in there as well. So see, now you can live off dividends and you don't have to cash out on money, right? That money's coming to you every single month, right? So now there's a lot more strategies that you can use as your balance increase. So that's why doing these strategies, guys, you got to focus on building liquidity, right? Really focus on building your account balance up, living a 70-30 life as long as possible. So now you have more options and more investment options that say, hey, look, now we can live like the rich and the wealthy. Now we can manage our portfolio like millionaires and billionaires are supposed to do. We can focus on having 10 mil minimum, right? So that, again, that's the things that Mark and I talk about on a daily basis, where this is where I got to get to. Right? We have to have more options, but some people call me and they say, well, Chris, I want to have the best financial plan. Great, but you just can't have it right now, right? See, it's levels to it, right? You may have to start off with a starter pack first, and then we're going to graduate to something else. Then we're going to graduate, but we can't do these top tier billionaire strategies now, and we got under $1 million saved up in our account.
I just can't wait till that booster.
That also lends to the point too, Chris. And when you discuss these strategies, all for a purpose. And I think it's a purpose that we don't really talk about too, the transfer of wealth. When we discuss generational wealth, I cannot emphasize the importance of the transfer of wealth. So when you work this plan and you get to the end, right? It's like getting to the end. You have to make sure your transfer of wealth is in place. And when you talk about $1 million dividend portfolio, a lot of people, you know what they do? They take some of that dividend income, they buy insurance policies, right? Because that increases the transfer of wealth. You're talking about triple tax exempt. You're talking about setting up trusts. You're talking about setting up estate plans, things that are allowing you to not only grow your capital when you're not here, because these are character choices. Because
Come on now, Q. Go ahead and talk to him. Talk to him, Q.
The thing about it is that we all say we want generational wealth, right? And I don't think that people understand what generational wealth is. Generational wealth is tending to soil and growing a tree that you'll never bear the fruits from, right? And you're growing money trees, you're planting seeds for other people. So it's not just putting this plan in place so you can get to where you want to go. It's getting this plan in place and making sure that the mission is still going when you're not here, right? So we do all these things now. We go from, $50,000 a year to $250,000 to a walk away, but we cannot forget the most integral part of the walk away, which is basically making sure that everything that we have is transferred to our family in a proper way, in a tax efficient way. Small things like having the beneficiaries on your account, working with professionals who are going to enable you to reach your highest potential, but making sure at the end that transfer of wealth goes to your family, so that money tree will continue to grow and someone in your family can grow another money tree, right? And that's how we see Rockefellers and we see those kind of families that have that kind of wealth. They're not only doing things while they're here, things are in place when they're gone. And I can't stress that enough.
And I don't want to say nothing. Yeah, that's just huge. I just get excited. You know what I'm saying? Just get excited about having great conversations about money, right? About wealth.
I just can't wait till that booster guy comes out.
Right? Come on, man. Right? So everybody should have a foundation of irrevocable trust.
Yep.
Right? That's the foundation. That's the basics. Right? Before you get into the dynasty trust is on it. Look, you need to have a trust. So that way on your insurance policies again, should not be people should not be the beneficiary of your life insurance policies, right? It should be your trust to be the beneficiary of your insurance policy. The only thing that should really have a person's name on it, as far as transition through wealth, would probably be an IRA. Everything else, a trust, your beneficiary should always be in the name of a trust. Yep, everything. Right, guys, you got it. That's so important. Again, we'll kind of talk about on a later episode about how you can really use life insurance in a different way to really increase your investment strategy, to make sure you pass on generational wealth, make sure you can have tax-free income coming in. There's so many different ways, but guys, we got to get to that point first, right? Yep. Man, it's just so many different levels.
Well, I'm just gonna say this. I was just thinking about, like, what's the coldest stunt, Jolene?
What?
When not only can you do those things for your generations, but the profits take care of everything. Come on.
Oh, that is a really nice stunt.
That's the OD stunt.
Yeah.
But yeah, everybody, I accidentally kind of hinted at something, and I guess they're definitely catching on, because we've started off with the starter pack, but I did just hint at a booster pack.
Come on, we got the booster pack coming.
Oh, because honestly, like that starter pack, like as Tiwa would say, is getting chunky, and I do not want cousins to go to the starter pack and feel overwhelmed. That thing really should have 9 videos, and then we make a whole new other next level pack. Because I know how we are. We'll see that, especially you just beginning, and then you're like, what, 50 videos? Nah.
Nah.
You gotta make
All
it.
right. So we got a few questions to hit. So let's do it.
Can we do a lightning round? Just
okay. Well, here's a lightning question.
okay.
Can you live without using any credit at all?
I mean, you can,
but why would you? Why would you want to?
Why wouldn't you leverage, right? Like, why wouldn't you leverage someone else's money to get paid? Like, just think about it in that sense. You can live without credit, but then you're living without leverage. And the most important thing you have, whether it's a negotiation or whether it is, let's say, for example, getting something to eat, right, is leveraging options. And so when you think about when you were in college, you were a broke college student, all you can eat is McDonald's, right? And then when you become an adult and you get to the bag, it's like you can still eat McDonald's, but Morton's just tastes better, right? Pause, but it just tastes better in a sense. All right, pause that. Kind of crazy. But yeah, you know what I mean? So I wouldn't live without credit, but you can if you want.
Yeah.
Okay, here's a quick question. Should you create a business before walking away?
Yeah, I mean, again, I'm a big proponent of having a business, right? The one thing that I love about having a business is transitioning from a W-2 mentality to a business owner mentality. Number one, that you're taxed differently. Yep. Right? When I was an engineer, I was getting taxed like 35, 40%. Okay, I own a business, I get taxed less than 10%. So why would I not have a business, right? Now, it's not about having a business to walk away. It needs to be a legitimate business. You can start that business now part-time. Right? There's so many hours in a week that we waste. You guys start a business on a part-time basis, right? Right now, while you have your job, that means that's extra money that you can invest to pay down debt, to do other things that you can. And then as you transition, now you got more tax write-offs. You have a better life, right? A business is like number one of wealth building. Business, right? I don't know. I haven't met a W-2 employee that's completely financially free, have $200,000, $300,000 coming in a year, and work less than 30 years.
I would definitely say, like, I'm definitely a huge proponent of you having a business before you walk away. I mean, I love the fact that Monroe Inc. is, alive and kicking and well-oiled. So, speaking of which, should you trade in your LLC?
Sure. Right. If you have a real business, like you just can't open up an LLC and just say, hey, I'm going to trade in it. You don't get tax deductions for trading into it or investing in an LLC account. Right now, if you're if you reach trader tax status, then yes, you're running it as a business though. Right. You have to have a certain amount of trades per year. Yep. I mean, really per month. You got to, it's
pretty
real.
Much a pattern day trader.
A pattern day trader. But a lot of times if you're doing an option strategy, you're not considered a pattern day trader. But so you can invest inside your LLC because it's really just an extension of your bank account. Yep. It's just really investing differently, right? In my LLC account, boom, we do that.
All right, so I'm looking at most of these questions you guys have answered.
Oh, I got one.
Okay, go ahead.
How to prepare for down years?
Just get excited and be ready to buy.
But
So
that
I
goes,
guess go ahead, Q. Go ahead.
well, no, I was saying that goes back to the point of having that cash as a position.
Gotta have it.
And that's the way you prepare for down years, right? Again, you have opportunity. We see merger and acquisitions in the market. Why? They were ready for the opportunity, whether they were raising capital or they have cash on hand to make that purchase of the company to improve themselves. They were ready. Sometimes the other company wasn't ready, right? The company in competition may not be ready. So, it goes back to your whole point of across the board, having those quarterly meetings with yourself, having those quarterly investor meetings with yourself and looking across the board and saying, okay, if I were to walk up to somebody today and say, hey, invest in me, give me $100,000, would I invest in me? Would I invest in me, Co? Right? And having that open, honest conversation, it goes back to that. Because if your paperwork's not in order, it's going to show, and you're going to have to go back and fix it. And now you're wasting time and money. It's one thing to waste money, because if I'm wasting money, usually I'm saving time. But if you're doing both, then as a CEO, your stock is having a down year as well. So not only is the market down, but you're down. You want to make sure that you're able to rise above a market that's showing trepidation, right? And that goes by having your paperwork in order and having that cash as a position as you're growing your balance sheet.
So go ahead, Chris.
No, go ahead.
No, it was another question.
Well, it was a question on here that I wanted to address that was on here about health insurance.
Yes. So go ahead.
No, so I think one thing we got to focus on, guys, a lot of say, man, Chris, if I walk away, right, or even when I'm talking to clients and they want to retire, they say, Chris, I don't want to retire because, man, I'm going to lose my health insurance. Guys, look, for most people, you probably pay $500 a month for your car, $500 a month for your wife's car. You're probably paying $300 a month in car insurance. So you're paying $1,200 a month in cars and travel. Right. So then you complain about, well, what about my benefits? You can't let your benefits from your job keep you in bondage. Does that make sense? Because again, health insurance, you can go get it and probably better in a private market for what, $600 to $1,200 a month?
Can you say that again for the people in the back?
Bro, don't let your benefits of your job keep you in bondage. That's not a benefit. The benefit, if a job can't give me freedom, if a job can't give me overrides, if a job can't say, look, I can do whatever I want to do whenever I want to do, that's not a benefit. That's bondage.
So another thing that you can do is if you have walked away with health insurance, you could just pretty much just prepay it. You can either prepay it by 6 months or for the whole year.
Yeah. If you have a business, then you have your business has health insurance. Now it's a tax write-off. Either way.
Boom.
Man, just walk away. You know what? Just call it quits tomorrow.
So I know that there's two questions that we got to hit. Where to shelter 8 to 9 figures of wealth?
Lord have mercy.
Trust.
I mean, it's pretty simple, right?
you can do whatever you want. I mean, you got 8 to 9 figures, so you can do every single strategy in the world, right?
Trust is the way to go.
Yeah, I think it's about not only I think we focus a lot too on growing capital. It's also about preservation of capital, right? And Chris, as your job, and I have my 7 too. It's like we're fiduciaries, right? So the first part of your job is preservation of capital. It's not just to grow the capital, but to protect the capital. And so I think that's what you have to be protective of what you've grown, and kind of put a fence around your farm, let's say. So that the scarecrows and other animals don't come and eat your fruits in a sense, aka taxes. So, trust obviously makes the most sense because it's a living, breathing entity, right? But at the same time, you can get away with a lot of loopholes and a lot of things you can do within that trust that make it much easier to move around rather than being a single person and having that in one account or an individualized brokerage account.
Yeah, it's just amazing. We were working on a strategy today for a client just about the trust. And again, there's different strategies you can use. That you can even have non-qualified money inside of a trust, but the money can be completely tax deferred. Eventually, transition that to more tax free. Like it's so many different things that you can do, guys. Again, but we got to start from the foundation, right? Have a solid financial team, right? You got to have a great estate planner that knows what they're talking about, right? You got to make sure you have a great CPA, a great financial advisor. You got to have a great person that's in health insurance and life insurance. You got to build your financial team, right? And to say, hey, look, every single quarter, every single 6 months, my financial team is meeting and he's helping us, or they are helping us get to that next level, right? So, wealth can't be built by yourself.
Remember.
And then one thing I do want to say about that is, there are over 50,000 of y'all. Some of y'all are CPAs. Some of y'all are trust attorneys, whatever. Yo, start to make those connections, because another part of wealth that is key also is the relationships that you're building, and so as you see cousins talk about what they do or whatever, start to build out what your team looks like. One thing we get to do as like a people, as come up cousins, is work together. Have those dollars stay within the cousins, period. Because otherwise it's just going to go out and it won't come back. And if we're really about generational wealth, then we also get to be about having a generations a circulation, amongst the cousins. So start to think about like who's going to be your CPA. There are a whole bunch of CPAs within the cousins. There are. And you can start to build out your team. They're really, everything is here. It's all here. Y'all can have a conversation about what that looks like, but definitely build your teams with people that are of like mind and are on the same type of time as you, that have the same values of you, whether that be generosity, whether that be, integrity, whatever those values are. That's what's going to also aid in your walk away. People that you can count on no matter what. And that were also there before the walkaway, because you know how people say.
You bring up a great point, and I was talking to Chris about this, and I'm like, you guys, and I think the cousins don't realize we've created a country club, and at the same time, because we never had that in our society, right? Other cultures have country clubs or maybe cultural clubs they can go to where they break bread, they bring their family, they network amongst each other, they spend time, right? And it enables them to keep their dollars, their thoughts, and their ideas amongst themselves. And so what the Come Up Cousins have done over the course of time has created a Black country club, but we don't have a physical location. It's in the cloud, and it's on Facebook, and it's on Instagram, and it's in these messenger groups where we have these things, right? And almost a culmination of the country club is the cookout, right? Because at a country club, they have cookouts, they have their little things in soir ways, but we have our own country club that we've created amongst ourselves. And there's brilliance amongst us, right? And there are people who are CPAs, who are lawyers, who are doctors, who all serve different purposes. And you're talking to somebody every day who can serve a purpose in your life, who's on the same mission as you. And you guys haven't even talked about it. The same way that guys go on the golf course and they have these conversations and they lock in business, right? The doctor that goes to that country club, a lot of people, what they do, they go to that doctor. The lawyer who goes to that country club, right? Depending on what kind of law he does, a lot of people, what they do, they use that lawyer. That membership pays for itself. So the best part about this country club that we've created is that the membership's free, right? All you have to do is be passionate, be present, and be aware. And take your life to the next level.
That's country club.
Whoa. You just had your moment. Say it again for the people in the back.
All you gotta do is be passionate, right? Be present and be aware. Be aware of who you're around. I always say your network is your net worth, right? Who you know. It's not about what you know, it's about who you know. And everybody collaboratively we've worked together to get better at options trading and stocks and reading charts and everything like that. But to get better at life hand in hand with somebody who already has the same MO as you, who looks like you, right? That's where the power lies. So this infrastructure that we're talking about has already been put in place. It's now our job to move it forward, right? So when you're in these groups, have more dialogue, build these relationships before the cookout so that you can take your life to the next level ahead of the cookout, because you've been staring at somebody who can help take you to the next level for the last 6 months. You just haven't talked about it yet. And so that's why it's so important and so dope. And I was telling Chris, I'm like, yo, it's really a country club, because I'm really sitting amongst brilliance and excellence and people who look just like me, who are around the country doing phenomenal things. Just because you begin trading yesterday or 6 months ago doesn't mean that you're not phenomenal in your field and that you're not brilliant. So I think that that's an homage to what you guys have built, but also to the cousins, what they built organically. So I think that's like the dopest thing to me is like, I'm like, yo, I'm really amongst a country club. When I talk to people, I'm like, they don't realize in my mind, I'm on the golf course just talking to them. We're just having golf course. We're having drinks at the bar, just having a conversation, how somebody would do it at a country club. right? Let's have more of that dialogue. So I think that is going to move the group a lot further, a lot faster.
And let me just say this. Can we just have a moment right now? Okay. Like, let's just have a moment to talk about this cookout. Okay. Next year, what? It is going down. You hear me? It is going down. The Come Up Cousins cookout is going to be fire. That's number one. Number two, shout out to the event planning committee. Caleb, we see you as the head of that committee. You know, you all are doing phenomenal work. And I cannot wait. I know I'm going to just be out there just doing the most. DTM all day, all night. Okay.
I'll just be in the back sipping my water.
Because let me, like, you know what's really cool is, like, I feel like we've had like mini cookouts, like where, you know, Chris flew in, although, you know, you already knew each other before all this. You know, we're waiting for Q to come up to Seattle. Tivo was here. Tivo was here for my birthday weekend. We stayed at the same hotel on the same floor, living life. Okay. Super nice hotel overlooking the water, living life. It was so much fun. And it's one of those things where, you know, you talk to people on the internet, you know, and like, not everybody is, you don't have to like everybody. Let me just say that, you know, it's like, that's okay. But the people that you really connect with and then you see them in person, it's just so amazing. So I cannot wait until next year when we are in person, eye to eye, face to face, hug to hug, you know? Oh, it's going to be so much fun. I can't wait.
It's going to be lit, for real, for real. All right, so I think, well,
we're at 6:03. I feel like we answered all the questions. What else do you see?
Well, there is two more.
Okay.
So are the investment strategies different for people who are older?
Okay, that's a good question.
Absolutely. Okay, I think so. I think, man, where you're starting off in this journey is important. So I do have like a lot of the cousins that I've had conversations with, let's say that are over 60, right? Mm-hmm. Or over 55 years old, or maybe they are in retirement. Their financial plan is going to be different than somebody that again, that are our age, because maybe, again, their risk tolerance may be different. They can't necessarily take some of the ups and downs of Sharp. So we have to really build a full plan to where not only are we focused on growth, we have to also focus on protection. We have to focus on guaranteed income pretty much for life. Like, we got to make sure, look, that income portion of it has to be taken care of, right? The other conversations may be, hey, look, well, when should I take Social Security? Should I take it at 62? Should I take it at 67? Because for some of the older cousins, right, that's important, right? That extra $1,800, $2,500 is kind of a game changer. So I think it's completely different financial plan for, depending on age, I would say over 55. We got to start talking about more a diversified plan and how we're going to get income to make sure we live out the rest of our life, but also have a portion of it for growth.
Well, speaking of that, and it's like you kind of alluded to it earlier when you were talking about having that dividend investment. And so just thinking about, like, if you had, like, say, for example, $1 million, or let's say, you know, $250,000 in just liquidity sitting on the side, you can use that $250,000 and probably put it towards like a
MLP fund, right? That could potentially generate between 15 to 20% yield.
Yeah.
You know, so there's a lot of different, again, that's why it's so important, guys. There's so many different strategies that you can use. But yeah, MLP fund is great for a portion of your account.
Yeah.
So again, that may be not for somebody right now under $1 million, but you guys, we got to expand our vision. Mark is spending our vision this whole time to where we can't just look at $1 million and say we're okay. No, we literally, in these next 18, 24, 36 months, you can be over $1 million, $2 million, $3 million saved, right? It can change the game. What's wrong with Jolene?
Nothing.
I'm laughing at Tivo.
Oh, what's Tivo talking about?
Yo,
Tivo always got something cool to say.
Well, Jolene put him out here on blast talking about ocean views and everything.
Oh, come on. Oh.
Yeah, he was at a motel with the boat outside.
All right. So I guess the final thing to ask is how to balance over investing and knowing when to treat yourself in the 70-30 life. I think I'm going to pass this over to
I want to answer part of it.
First Lady of Leisure here.
The first part of that. So the question, repeat the questions. I'll make sure I got it.
Okay. How do you balance over investing and knowing when to treat yourself in the 70-30 life?
All right. So first of all, in the 70-30 life, from my perspective and what I got going on, the treats are part of my 30. Okay, that's me though. I like I said, there's just certain things that I'm just not going to go without. And you don't have to follow this, but how I see it is you have like your standards, right? And whatever those standards are, either if you're 30 out of your 70-30, if you can't afford, these standards that you would like to have, well, then you need to increase your income, either increase your income or decrease somewhere else. But then once you get to that place and space, then that becomes your standard. And then another thing is, as far as like treating yourself, I personally, when I make my money plan, I do not deviate from that money plan. So even if I have the money to, like, this is a real life example, y'all. There is this stainless steel espresso machine that I've been eyeing for some time. And I was like, yes, I have the actual physical dollars to go and buy it. But one thing I don't do, if it's not within my money plan, on my monthly money plan, I do not buy it. I just don't deviate. Like that discipline is so important to me that I don't deviate from that. But what I can do is make an account for that thing that I want. So I can do that because it's really important. Like when you get to this stage, it's important that the market buys it. I mean, I appreciate SMH, I appreciate RKK, like I appreciate XLK, I appreciate all them lavishing me with the life that I like. It's not coming out my pocket. So however you want to set it up, like it's important, one, to stay disciplined. Like if you gotta, quote unquote sacrifice for a short period of time so that your long-term is all stunt campaign, do that. And then you can also find other ways that you can have like your splurges. So I don't believe in just completely cutting yourself off from, all the joys in the world. However, you can do that for a short period of time if need be. Like I like to say, it's not an extreme change, it's a radical change. So what can you do that is radical? That may seem like out the box. If you're in a 2-bedroom, could you downsize to a 1-bedroom for a year just so you can have the extra money to invest? And then once you do that, well then, okay, now you living in a penthouse suite or whatever, flips your skirt, whatever that is. But there are ways to get this done, y'all. There are ways for the market to pay for your life. And like I always say, our ancestors have done all the labor that they could ever do for generation after generation after generation. And I'm not working no more. And you don't have to either. So think about what it is that is your standard. Get your 70-30, life together. Figure out what those components are. And this is what I would do. I would raise income and decrease expenses at the same time. Like I wouldn't just do one or the other. I would do both of them at the same time. So it looks like this. It looks like this. And you get to a point where the more income that you have, and that's another thing, money will just start attracting more and more money, more opportunities come. It's like when you look, smell, and you feel like money is like, oh, what's up with you? Money comes around. Like it just does. That's just how the laws of the universe are set up. It just works that way. And if you are a good steward and you are generous, I always say generosity is contagious. I can't even tell you the miracles upon miracles that have happened just because of operating in the spiritual law of generosity. I cannot tell you all of the miracles because they happen moment to moment. There's always a miracle. When you are aligned and walking in your purpose, more and more things are bestowed upon you because it is important that those that are aligned have access to resources. So yes, there will be a time when you feel like you may be, I don't want to say suffering, but low key, you may feel like you're suffering, but it is for a short moment. It is for a short moment. It is short term. It is not long term. But think about the radical impact that shift will have over the trajectory of your life, your child's life, whoever, over all that time. So to sum it up, 70-30. You can still treat yourself, but if you're going to treat yourself, let the market do it for you. And if you have to wait just a little bit longer so that, SMH can trick off on you, then do that.
Come on now. You better say something, Jolene.
Yo,
it ain't tricking if SMH got it. You feel me?
Yo,
Hear that?
In the words of Kirk Franklin, that's on Now Behold the Lamb right there. So, all right, y'all. So I know that we want to be good stewards of everybody else's time tonight, but we hope that you all enjoyed tonight's episode. If you think that we should do this again, go ahead and throw that up in the chat. We want to know what you all think about this. Should we keep this going? And could this be the start of, say, for example, that booster pack?
Come on now.
I will just tell people this, just to leave you off with some simple advice, though that I didn't talk about any significant investing. I would just say stay focused and focus more so towards liquidity. You don't always have to focus on like leverage and scale plays so immediately. Like I think I posted on Instagram the other day, is that, honestly, everybody wants to get rich quickly, but yet you should be focused on building wealth carefully. And so that should be the focus. I guess I'll leave it there because there are some pretty phenomenal people here that I have had the opportunity to be on the stage with. So Chris, you get to grace us with your benediction for the evening. What would you like to leave with the people tonight?
Man, I think what you just kind of piggyback on what you said, I think it's about, this is a long-term game, guys. This is not a short-term game. The biggest thing that you guys can focus on is your contributions into the market. If you do have a job right now, it's a blessing, because I looked at my job when I had one as it was my top investor. Every single month, twice a month, it always paid me on time, the 1st and 15th, right? But I looked at my company, even though I quit my job in my mind, right? But I understood to where, hey, look, it's paying me every single month. So that's why it's so huge what Jolene is talking about as well. Living that 70-30 life. Your job is your best investor in your future life. Use that money to invest more into the market. So now you can grow over these next 18, 24, 36 months, right? But also remember, again, when we're saying 70-30 life, as your investments start to grow and compound, that 30% gets even more. So 30%, man, how can I look? Over these next 24 months, 30% is going to be more than enough. You may only need to live off 10%. You may get to a point to where you only can live off 5%. Come on now, sip some water, right? You may only live on 1%. So see, guys, this is just the beginning, but you have to let this play out. If you haven't been through a full cycle or all the 4 seasons of the market, then you just are still new. You still have time. Let's wait. Let's go make it happen. Put more money into the market. Let's save and invest, build a plan. And I'm going to see you guys. You know what? We're going to walk away together.
Locked arms. Locked arms.
Walk away together. You know what I'm saying?
Q, go ahead, man.
It was a good analogy, Q. Our metaphor.
I'm gonna say the strength of the foundation of your financial home is gonna dictate how many storms you can bear. Right. I think we've seen it this year. We've seen that the market doesn't go straight up, and that you need to have strength in your foundation. And that's being patient, that's being perseverant through everything, right? Through these storms that we have in the market. But that's not only investing in the market, that's investing in yourself. And so I think it's vitally important every day that as a CEO of UCO, that you look in the mirror and you understand that your company has gotten better, right? And what I mean by that is that when I go to bed at night, I know that the share price of QCO went up, right? I know maybe it was 1 cent, maybe it was $2, but I know the shares went up. And I'm confident that if I had to pitch myself to somebody and say, hey, I'm Quentin Martin, right? This is QCO. I need you to invest $100,000 in me, that they would, because I can show them my balance sheet. But also the strength and the foundation of my financial home will allow me to bear storms, which allows me to bear the fruits later on, right? And then we're going to grow those money trees, right? And tend to that soil so that the people who look like me when I'm not here, they know who I am, right? Because the biggest thing that I always tell people all the time is that this is a legacy thing, right? And you don't get to tell your legacy. People will tell your legacy, and your legacy is built on how you make people feel. It's built on how you treat people. It's built on what you teach people. And so this thing right here that we're building is bigger than money in my pocket. It's bigger than money in your account. This is a legacy project for a culture, right? And I think when you grasp that, you understand how strong this foundation has to be, because we're making noise, which means we're going to bear storms. And if you're making noise and your foundation isn't strong, that storm's going to knock your house down, and you're going to have to rebuild that house. But as a collective, right, when that house is strong, we bear those storms. You know what? We can tend to that soil. So I'll leave you with that at the end of the day, is your share price going up? Your share price raised today for UCO, and only you know that.
I just want to say, first of all, thank you all for, being here on this Wednesday special. And also, I just want to acknowledge Christopher W. M.F. Bush, Mark Monroe, Quentin Martin, for modeling what, how can I say it? Modeling what love looks like on a deep friendship level between Black women and Black men. I think that is something that we don't see that often in our culture, not platonically. You might see it romantically, or, some other stuff that looks quite toxic. But I just want to acknowledge you three in that. It means a lot to me. I know it means a lot to my husband. And I know it means a lot to the cousins to see Black people loving one another and being able to talk about wealth and being able to talk about this collective walkaway and the impact that it will have on our community and on the culture from, way past when this video, is collecting dust, like, when the internet morphs into something else and now you got to access the videos some like ancient way or whatever. So I just want to thank you all. Oh, and I include TiVo in that too. Y'all can't see him, but I definitely include TiVo in that as well. Like, it's awesome to have, well, I'm older than some of y'all, but it's awesome to have, I'll say brothers instead of big brother, little brother. It's awesome to have brothers.
It's funny because we're all taller than you.
Whatever.
I think
not even by that much.
6'4", 6'5".
You gotta be 6'4", 6'5" over here.
Whatever. Yeah. Not even, y'all are not that much taller than me, okay? Like, I'm pretty tall. Y'all ain't that much taller.
I haven't seen you, so I haven't. It's been a while.
Shut up! What? I told you. next week, wait. If you're here next week, I'll see you.
I'm just joking. Y'all, thank you so much for rocking with us. And from what I'm gathering, so no Jared, none of that Jackson nonsense here.
Oh Lord.
Just wanted to put that out there. But yeah, I definitely want to thank you, Q, and you, Chris, for definitely doing this. I know there could be a potential series between the two of these gentlemen in the future. You never know. I mean, I think it would be dope. What do you think about Walkaway Wednesdays?
That's a nice ring for it.
We'll just let that ponder around for a minute.
Come on.
Just let it simmer for a bit. May not be every week, but because I know that you guys are super duper busy and everything else, but
it'll be nice. It'll be cool.
You never know. All right, y'all. Well, until next time, thank you for rocking with us, and I guess we'll see you tomorrow.
Thursday, we back, baby. We back.
We coming through with the hot takes. Okay. We already know how this is going to go. Anyway, so we'll see you guys in the next one. Be sure to subscribe if you haven't. Like the video if you liked it. And on top of that, hit the bell if you want to be in the know for when the next one drops. Until next time, I'm Mark Monroe.
I'm Christopher Bush.
I'm the big cousin, Q.
And I'm Jolene GC, in a place that is quite leisurely.
Oh, come on now.
And this was your come up. We'll see you guys tomorrow. Peace.